investor friends, I'm Michelle Markey and welcome back to my channel. If you haven't already, I'd love if you could please like and subscribe to my video and YouTube channel because it helps YouTube share my video to others who are also interested in learning about personal finance and investing topics. So thank you so much for doing that and I greatly appreciate it. And with today's topic, I'm going to explain the answer to the question, do stock splits make stocks cheaper? And the short answer is unfortunately not really. Like on the face value, they might seem cheaper and psychologically they're more affordable to us, so we might want to be buying more stocks when they seem like in dollar amounts to be somewhat cheaper. But I'll explain in a couple of analogies of how it doesn't really change the full value of what you're buying when you buy any given public company stock. So if there's one share of a company and it's worth $5, let's say the company doesn't want to just have one person owning this one share worth $5 and they want to split the one share into 5. So now you have 5 singles or 5 shares worth $1 each, and these are both worth the same amount. So the same company is worth $5, but now there's just 5 shares of them in terms of singles, so they can give it out to more people. And that's basically what happens in a stock split, is that it usually means that there's an increase in the shares outstanding. And in another analogy, let's say we take a $16 pepperoni pizza pie, and if we usually split that into 8 slices, that means each slice is worth $2. But let's say you want to have more people be able to have some of the pizza, you could decide to split it into 16 slices at $1 each. But that doesn't mean that the value of the whole pizza pie is worth more just because there's more shares or slices outstanding. It just means that there's smaller pieces to go around whenever a company splits its shares, but the overall market value of the company is relatively the same. In addition to making stock shares appear to be more accessible by making each share's nominal value or face value or par value to be a lower dollar amount, some of the other reasons for doing stock splits include making shares more liquid in the stock market. So that just means that they're able to be traded more easily, and then also that it increases a stock's marketability. So maybe the stock appears to be more attractive to buy just because it has a lower dollar amount associated with each share. 2 examples of some relatively recent stock splits include from popular companies Apple and Tesla, and they happen to actually split on the same day, August 31, 2020, most recently. And with Apple, that had been trading at $499.23 at the close of Friday, August 28. And then by Monday morning, it did a 4-to-1 split. So each share then traded at $124.81 on the markets open on Monday morning, August 31. And similarly, Tesla did a 5-to-1 split. So their shares on Friday had closed at $2,213.40. And by splitting by 5, that became $442.68. And so we've seen since then that Tesla shares have actually gone up. So it's no wonder that Tesla split. And if we reverse some of Apple's splits recently, we can see what it would have been if we compare it to how the shares were in 2012, which had hit a high of $702 per share. And if I reverse it in the recent 2 splits of taking out 2020 and 2014, and 2020 was a 4-to-1 split and 2014 was a 7-to-1 split, then Apple shares would have grown from $700 a share to $4,060 a share, and that's almost 6 times what it would have been 9 years ago. So it just goes to show, if we reverse the share splits of Apple and Tesla, then their shares could be priced as high as $4,000 something per share, and that's not very attractive to everyday retail investors to want to invest in. When a company's management is generally confident that their company will continue to perform well, and if market sentiment agrees with them, then as soon as they announce they're going to have a stock split, that can inspire a lot of investors to pile into the stock in anticipation of the stock split. And so with companies like Tesla, when they announced a few weeks before they actually split the shares, then their stock price actually increased by around 70 to 80%, which was pretty significant. And with Apple, there was somewhat of a stock price increase with some investors also piling in a month before they announced. But but it wasn't as big of an impact as it was with Tesla. And then shortly thereafter, we can usually see the stock price actually go down a little bit because suddenly some funds and institutional investors may not want to have as many shares allocated to these companies. So then they might decide to take some profits and kind of reduce their share count in order to balance their portfolios. But then eventually, generally investors like the idea that the stocks are nominally at a smaller price, so then it makes them want to actually buy more. And over time, the stock prices generally go back up. So that tends to happen with a lot of the aftermath of stock splits. And we can see with Apple, unlike Tesla, they've had more modest gains since they split the shares. And looking back at some of Apple's history in their stock splits, we can see that if they had never split, their shares would now be priced at $20,000 per share. But we can see that they've done 5 splits. And to recall some of their 5 stock splits in history, we can see that they first split on June 16, 1987, where they did a 2-for-1, and the price before the split was $79. And then again, during the dot-com bubble, they split on June 21, 2000, 2-to-1 again, and it was $111 before the split. And on February 28, 2005, they had again a 2-to-1 split, and the price was $90 before the split. On June 9, 2014, they did a 7-for-1 split, and the price before the split was $656. And like I just mentioned, on August 28th, the stock price was $499 before it then split on Monday morning, August 31, in a 4-to-1 split. So we can see that this was pretty interesting for Apple to split all of its shares and how they wanted to make their stock more accessible to more people. And like I mentioned, Apple was trading at $499 a share on the Friday before they had a stock split on Monday, August 31, 2020, and they did a 4-to-1 split. And back then, Apple's market cap was $2 trillion, and now that's increased to $2.4 trillion with shares outstanding of 16.5 billion shares. And even though it can be tempting to want to buy stocks when they're splitting and it appears as if on face value it seems cheaper, there are some articles that warn that you should tread lightly when maybe stocks are about to split because it may not be really worth what it's currently trading for. So just because there's a lot of hype surrounding it, more often than not, you might be better off ignoring when stocks happen to split and try to figure out what price you should actually pay for a company's stock. And this could be before the stock splits or even after the stock splits. You have to determine what is a good price to pay for a company that you believe in and that you've done your homework researching, because just because a stock splits doesn't mean that you should automatically go buy some of it. Another reason why a company might want to split its stock is so it can remain within a similar price range as other stocks in the same index, like the Dow Jones Industrial Average that features 30 prominent companies that are listed on US stock exchanges. And among these, we can see that United Health Group is in the top $400 per share range. And this goes down the line, and Apple is in the bottom half of the pack. And we can see that some of the lower $40 to $50 range companies include the likes of Coca-Cola, Verizon, and Walgreens. So Apple maybe doesn't want to outshine some of these companies by having a higher stock price, so it's happy with being somewhere in the pack. A lot of people know that Warren Buffett of Berkshire Hathaway has long resisted splitting Berkshire Hathaway shares, and he finally did in 1996 to carve out Berkshire B shares out of Berkshire A shares. But for the longest time, Berkshire A shares have been some of the most nominally expensive shares on the market, and they still are today, hovering in the $400,000 per share range. And that might be a pretty hefty price tag for a lot of people if it costs the same amount to buy Berkshire A stock as it would maybe buying a house. And so that means that a lot of people back in the 90s were scheming of ways to split Berkshire shares artificially, and some mutual funds were planning to buy Berkshire A shares and then parceling out some portions of the value of those shares through their mutual fund in smaller denomination pieces. And so Warren Buffett didn't want to have his shares be subjected to that kind of abuse, so he decided to allow for there to be authorized Berkshire B shares. And this happened in 1996, where Berkshire B shares came around at 1/30 of the value of Berkshire A shares. And And then they also had a further 50-to-1 split in 2010 where Berkshire B shares replaced Burlington Northern Santa Fe stock. And so that's how we came to have Berkshire B shares. And so Berkshire B shares are pretty affordable to a lot of people, and they're in the range of $200 to $300 a share. And nowadays with fractional shares, that may be even less of an issue where people can just buy fractions of shares. But I'm pretty sure people can't buy fractions of Berkshire A shares. Right now, they probably could maybe only buy fractions of Berkshire B shares if they really needed to. But I think that Berkshire B shares being at around $200 to $300 per share is generally more affordable, even if it's not necessarily a price that you should just go out and buy immediately. You should do your homework and figure out what price you should pay for Berkshire B shares if you want to buy them. Sometimes, if a stock's shares are trading at too low of a face value amount, such as $1 or less on the New York Stock Exchange, then some companies start getting worried that they could be delisted, and then they don't want to go through that ordeal. And so what they'll sometimes do is a reverse stock split. And Citigroup did this in 2011 where they did a 1-for-10 reverse stock split. So their shares were trading down as low as $4.50 per share. And when they did the reverse 1-for-10 split, that means that they reduced the amount of shares outstanding. And so if you had 10 shares, this became 1 share, and so each share became $45 instead of $4.50 per share, and that's what Citigroup did so that their share price didn't seem too low. That's basically the gist behind stock splits. And let me know in the comments what you think about stock splits, and let me know if I missed anything that I should have discussed. And if you enjoyed this video or learned something, please like and subscribe, and I wish you well on your journey to being the best investor you can be. Till next time.